Hello and welcome back. I'm Blake again, and we're going to go over what happened in the markets this March 1st, 2023. Today, the overlining headline was more or less dollar continues to rise at a staggering pace, bond yields continue to rise, and commodities continue to fall, minus oil, unfortunately, continued moving higher. On the night of February 28th, we saw the dollar start to tick down, and it continued to tick down early in the morning on March 1st. Throughout the later of the day, we continued to see the dollar march higher, not reaching a weekly high, but definitely approaching kind of the weekly average, definitely beating out and reaching a high, relative to the sell-off. As far as bond yields, we saw the 10-year tick over, 4.1 or almost 4.1, just 4.0 and, almost to the 4.1. And we saw the 2-year all the way up to 4.9 in the after hours. Definitely showing that investors more or less are thinking that the Fed will continue to hike, and in fact that the Fed might be well behind the curve and might need to pick up the pace at which they are hiking, which would definitely signal a downturn in equities, housing especially, and commodities, just about everything that's denoted in dollars, which is more or less everything. Definitely not an optimistic outlook, but that's more or less what the data has been providing, and the market continues to be reacting to the data, which is, efficient market hypothesis, more or less continues to hold true. If anything, it was maybe a little bit slow this time, in my personal opinion, but it's definitely catching up, and I would bet to continue that this rate of movement in the dollar and in bond yields and the reaction to that all other equities have to those two movements will more or less probably continue up until the Fed meeting. The only two big things that would possibly change this would be the jobs data coming out March 10th or the CPI coming out March 14th. So on the 14th of March, it's predicted that the CPI will more or less stay on pace. I could go over the exact decimal point. I probably will tomorrow. But the current estimate, actually I probably will in like 2 days when the estimates are more finalized. But the current estimates are more or less that we're going to keep on pace with inflation of January, which, take in mind, was a big uptick from what we saw in December, November, September of 2022. So we're more or less going to see more of the same, which is, an elevated from the rate that we saw that was continuing to go down. Now we're seeing more or less a flat rate, but the rate is higher than what a lot of people were hoping, and more or less signals that we got to get this rate to ideally zero. That wouldn't be it'd be disinflation, but it wouldn't be deflation. Just, prices holding at the current levels. I think we'd see a lot more happiness if we could just get a few months of zero, or ideally -1, but I think that's kind of a long shot, especially the short term, with the recent data coming in rather hot. We see oil more or less hovering around that like $76 to $78 a barrel, but gasoline RBOB on the 28th had a huge run. It went up 8% in the after hours trading, almost 9%, which definitely was a large move for, consumer level gas. So definitely expect that at the pump in the near future, probably the next week to 3, you could easily see gas pump prices going up anywhere from 30 cents a gallon all the way up to potentially, maybe 50 cents a gallon. So, if you got a big tank, I'd recommend filling up now, because, there's definitely going to be a price hike that a lot of people are going to see in gas coming up in the next couple weeks. But as far as long term, definitely, not bullish on oil. I do believe that oil in the long term will go down, but in the near future, it's looking like it's holding at these levels, and there could even be a spike up. Take in mind the Russian gas, which is denoted as Urals, is currently holding at 56 cents. Definitely saw a big tick down after you saw the insurance companies refuse to insure any kind of ship moving Russian gas, whether it was from Russia or any country allied or not allied with Russia. that was not obliging to the price cap set by NATO and the EU. So this definitely was probably the most successful action that we've seen by the West against Russia, and it definitely appears to be working, better than just about everything else, which, if you've been following it rather closely, you've known that a lot of the action that the West has taken against Russia has definitely kind of shot the West in the foot harder than it shot Russia in the foot. But, due to their bad economic circumstances going into the war and also being bogged down by the war, is obviously hurting them immensely just due to their current predicament. But take in mind, by like a dollar to dollar comparison, obviously, as a lot of you might know, we definitely saw a lot of foot shooting, if you would, from the West in the last the last 3 to 12 months when the war started. It's been just over a year at this point. In general, commodities trended down. Another big notable one is lumber. We saw lumber down over 7% on the day. This is a huge move down in lumber. Definitely a lot of probably futures traders and just speculators definitely starting to price in more and more of this construction slowdown, just due to the fact that housing is going to have a massive slowdown. Don't get me wrong, we saw the data that came out 2 days ago where we saw rent prices, especially in apartments, massively tick down for the 6th month in a row. We saw massive rent inflation, especially in apartments, for the last 2 years ever since this, inflationary cycle has begun. But now it's just been tick down, tick down, tick down every single month with rent. Definitely providing renters with a fair amount of relief and giving them more opportunity. A lot of people speculate that the main cause of this is people, moving back in with others, like younger professionals or students moving back in with parents, or multiple different young professionals moving into one housing unit. More or less housing consolidation, where you have more people willing to share a space just to get down the cost of rent, just due to the high prices that we've seen recently. And also, with this rent ticking down, a lot of people sign year-long leases. So even though it's ticking down month by month, you have a lot of people that are locked in around the top of when rent prices were. So they're more or less going to be continuing paying these prices for the next year to 2, or however long they sign the lease. So a lot of people don't even realize more or less what's going on in the rental market until they go to look for their next lease. But at least this time, for the first time in a while, a lot of renters will probably be happy with the news and might have moved a little bit prematurely to downsize their rental, current situation. Whereas, they more or less probably did this to offset the other inflationary items that were eating up into their budget. Take in mind, we still haven't seen much relief in, the CPI and other things, but as far as rent, which makes up a large part of the CPI, we're definitely seeing a tick down. But I meant to say core CPI. Core is still relatively high, but we're definitely continuing to see the tick down in the actual CPI because of the downtick in rents, the downtick in gas and food, which are the main difference between core and the normal CPI, which definitely gives a lot of people relief. And hopefully this is offset, but the big problem with this is the downset in wage increases. Don't get me wrong, we're still positive in wage increases, and obviously too high of wage increases is very inflationary, but we're starting to see this tick down, and you're starting to see companies like Lyft, Uber, other kind of gig economy jobs reporting a surplus in workers, and companies like Chipotle on their last earnings call saying that it has become significantly easier to hold their current employees that they have, because now there's just a lot less, come over, work at our fast food joint, we'll pay you another $2 an hour. You work there for a few months, oh, come over here, we'll give you another $1 an hour. There's definitely a lot less of employers incentivizing people just due to the fact that staffing is now more adequate, and the labor participation rate, while it still isn't as high as it was pre-pandemic, has more or less been a slow, continuous tick upward. as you see people having to re-enter the labor force due to the high costs of just staying alive in this country. As far as notable data that we're going to be going over, since we missed the video yesterday, there wasn't that much notable. It was more or less a pretty muted day, but a few big things that came out data-wise that I want to go over. So the trade balance more or less was in line with expectation, a small tick down, but more or less the same. Retail, advanced retail inventories more or less was exactly as it was the last month. Advanced wholesale inventories, though, saw a massive tick down. We saw negative 0.4 in January, whereas the previous month we saw a 0.1% increase. So definitely showing that while retailers are still at the same pace, wholesale is more, which is definitely more of a predicting entity than retail in itself, is predicting a glut in inventory and has massively pulled back on the amount of inventory they have, not purchasing as much and letting the existing inventory go off the shelves without replacement. That's more or less what negative means, is they now have less inventory than they did the month prior, which obviously if you've been following for the last 6 months, you'll know we've kind of continuously had multiple different companies report just inventory gluts, like Target, mainly retailers. You saw a little bit from Costco and the Sam's Club division of Walmart, but not as much. But they're definitely now starting to predict a big pullback, at least with the data. That's what we're currently seeing, which was quite a shock. As far as the S&P Case-Shiller Home Price Index for the 20 cities, this is the 20 biggest metro cities in the U.S. year over year. We were expected a 5.2% increase year over year. This is from December, so 2 months ago, obviously. 2 full months ago at this point, now that we're in March. But in fact, we saw even lower. And take in mind, this was less than the previous month of November, which we saw 6.8%. So we were already predicting a decline of 1.6%. But in fact, we saw a decline of 2.2%. Quite the drop in home prices. And once we see, the year-over-year comparisons in anywhere from, May to end of July, which obviously, there's like a 2 or 3 month delay before they report them, we're going to see massive negatives, like at least 10%, which will definitely send off a lot of alarm bells, definitely will make the mainstream media, and definitely will cause, retail, normal homeowners to see a little bit more panic, as opposed to the last, 2.5 years, where housing prices have just been on a straight rocket ship up, like a lot of assets. So obviously they're not the biggest culprit of running up the economy, causing inflation. But with that being said, on the other hand, the household wealth effect is definitely most pronounced in real estate. When people get rich in real estate, they definitely spend more, at least psychologically, on a national level compared to buying stocks. People don't tend to upgrade their lifestyle if their stock portfolio goes up 20%. But on the other hand, if their house is now worth 20 to 30, 20% more, you could easily see people, upgrading their lifestyle, renovating their home, taking out a HELOC to try to, take back some of that equity so they can use it in their life, which causes obviously inflation and lifestyle inflation. And I think we're going to see a crashing down of both these in the coming months. It's just a question of if it'll happen, right after we see the year-over-year comparisons, or if it's going to be a delay after that. That's more or less my question. Or there's even a small chance that, given this last data from the S&P Case-Shiller Home Price Index, that we could just naturally see it. And then when we get the mainstream media piling on and telling everyone, oh man, home prices are crashing, it could be ugly. Like, 10% would be, just the beginning of the first month. That would definitely, cause a lot of homeowners to freak out. We see the inventory pile up, and no sellers come in to buy, and it's just a race to the bottom. But obviously, either way, I think that's at least a month or two out. And I would I think it's highly unlikely that even in a month or two we'll see either of those. As far as consumer confidence, luckily we saw this one drop. It was expected to even go up again to 108.5 as opposed to the previous month of 106. But in fact, we saw a pretty significant drop to 102.9. Definitely not as big of a drop as some people are obviously hoping, but still quite the drop, and signifies that consumers are starting to become more and more tapped out. We now see credit card debt in America sitting at over $1 trillion, and with rates continuing to go up and interest continuing to go up, you're seeing a lot of people having to fork over a ton of money just to pay on debt. And obviously with debt rising and studies showing that just in the last year over 70% of Americans added to their debt with these rate hikes, you're going to see a lot more people that if it's not like a personal loan locked in at a set rate, have their payments go up, have the interest go up, and get drowned in this debt, unfortunately. As far as data that came out today, March 1st, take in mind I'm reporting this at night, so it's technically March 2nd for me, but just barely. We see the ISM manufacturing more or less online with expectation, and we see construction spending luckily ticking down another 1%. Last month it went down 0.7%, and it was predicted to actually go up 0.3%. With contractors and home builders more or less getting ready for the new year, you typically see January as one of the months that is more has more construction starts, has more construction spending. But we saw a negative on the month. And take in mind this is the January data. There's a 2-month delay in this data set. But so definitely shows that people in the industry are predicting a slowdown and are planning accordingly. More or less the same news that we've been getting recently, and at least it shows that housing isn't continuing to be an inflationary boon in the economy, which a lot of people are more or less pretty happy to see. Big data that we got coming out tomorrow. We got the initial joblessness claims expected to be at 197,000 as opposed to the previous month, which was 192,000. Another big thing is the U.S. productivity revision for Q4. The first productivity estimate was 3%, but obviously you saw the same thing with the GDP. You saw a big tick down between the first report and the revision, and it looks like we're going to get a similar thing here with the productivity ticking down to 2.5%. And I'm not going to lie, I'm not an expert on how exactly they calculate the U.S. productivity. Well, at least the government calculates it. But even this, I think, is a little bit optimistic if I were guessing. It just does not appear that manufacturing productivity, U.S. worker productivity, sure you saw a little bit of, back to office work come into play, which definitely more or less shows that people are going to have to put in more hours and are going to have to be more accountable at the workplace. But as far as manufacturing, you've continued to see all the Fed, local offices report massive tick downs. You saw, wholesale inventories going down. You saw construction going down. So I'm not exactly sure why productivity continues to go up. Take in mind this is Q4, so this is, from the September to the end of December. But it doesn't seem appropriate. But it is expected to be revised down 0.5% to 2.5%, but we'll see what happens when the data comes out tomorrow at 8:30 Eastern. The last big data point coming out tomorrow is we have the U.S. labor costs revision from Q4. It was actually first reported at 1.1%, and it's expected to tick up to 1.4%. So it kind of contradicts the productivity, because unit labor is for, relative to the amount of, the unit of the labor. So as an individual, you're seeing more spending for less work. and they're still predicting it's going to tick up. So definitely an interesting guess. We'll see what the data comes out tomorrow on the revision, but take in mind, typically the revisions aren't this different than the first reported data, but with the GDP being this out of alignment, I wouldn't be shocked at all. It's just a question of, I would predict it to go down, not up, especially given that in the last few months we've seen wage inflation massively tick down. Still, wages are going up, but nowhere close to the same rate that they were. Take in mind, this is the Q4 data, so it does end in this. It's beginning of September to end of December, but definitely doesn't really add up with a lot of the data we've seen from December onward. But we'll see what the data comes out when it comes out at 8:30 tomorrow Eastern. As far as the markets as a whole, we saw the Dow go up just barely, 0.02%, so more or less flat. The S&P 500 ticked down 0.47%, and the NASDAQ went down 6.8%. Definitely was down a little bit more earlier in the day, and then you saw a big rebound midday, and then more of a sell-off near the end, and then a small buyback, showing that there's still a lot of volatility in the market. A lot of people betting on each side, and now with the put to call ratio in the market becoming much more put centric and having a lot more hedging, especially compared to January and December, you could easily see a lot of more people being ready for a big downturn in the markets. Especially if we get employment data and the next CPI coming out, very hot. It would definitely force the Fed to have to reconsider its position, bump up to at least a 50 basis point hike. If it came in extremely hot, potentially even back to a 75 basis point hike, and would cause a lot of credibility to be lost in the Fed, but would be necessary to get inflation down. Obviously, an even worse outcome would be if they both came in extremely hot and we got another 25, because at that point it's game over. Inflation's going to the moon, and now we're going to have to more or less start this Fed rate hike cycle back over again, but now rates are at 5% as opposed to 0%. So it's a wildly different game, and you could see real estate, massively tick down. If you had to hike rates up to like 9-10%, you'd see a 30-year mortgage maybe sitting at like 15%. We haven't seen this stuff that unreal since like the early 80s, and even before that, the last time we saw that was back in the 50s. And obviously housing prices were definitely more conducive to that kind of pricing then, relative to wages than it is now. It took less than a year's wage to buy a house back then, where obviously now prices are way higher. But if rates went to that high, you would more or less have to see housing prices adjust to a similar rate of where wage to buying power would have to be equivalent to that in the 50s. And obviously that would be like an 80% plus decline. So I would definitely not, we'd have to mess up massively on the Fed side and the data side, which I think is virtually impossible to have that, people mess up that much on both sides. It's just not feasible. But it is still a minute possibility, and obviously if it does come true, I'll be sure to let you know, and we'll be planning accordingly from then on. Thanks for coming back here and watching more about the markets. I know it's scary times, but we'll get through it together. And I look forward to seeing you back here tomorrow, where we're going to be breaking down what happened again on March 2nd and tell you the moves we're making and what we're looking forward to in the future, and take it from there. You guys have a great night, and I'll be talking to you soon.